some future shows about stock account update today. Data points to an economic slowdown, and US stocks closed lower on Tuesday. So in my account today, I've added another 1,000 shares of which is Unity Software, at a price of $32.42. And just by today, it rose 1.25%. On the other hand, UNG, United States Natural Gas, decreased for 1.02% to $6.61. In the post-market, it rose back to 0.45%. Right now, the net asset of my account is $73,704.75. The reason that I bought Unity Software is because that I view it as a growth stock, as the interest yield of 10-year Treasury yield decreased from 4.2 to about 3.3. It is encouraging the tech stocks, the growth stocks, to grow, and Unity will have the potential in my perspective. At the same time, it decreased from 200 above 200 to right now less than 30, and I do believe that it has a strength of growing back. As for the market today, Dow Jones Industrial Average closed lower for 0.59%, NASDAQ closed lower for 0.52%, and S&P 500 closed lower for 0.58%. Most of the indexes closed lower, with special industry machinery closed lower for negative 3.39%, and the internet closed with a small gain of 1.08%. The semiconductor closed with a negative 1.53%. In the early morning of the 5th, U.S. stocks closed down on Tuesday. The market is still watching on the impact of higher oil prices. U.S. job openings data for February shows signs of impact of slowing down the economy, which analysts believe means that the Fed may end its interest rate hike cycle earlier and start a new easing cycle earlier. U.S. stock investors received an important labor market data on Tuesday. The number of job openings in the U.S. fell below 10 million in February for the first time since May 2021, compared with 10.4 million expected and 10.824 million in the previous month, according to the U.S. Job Openings and Labor Mobility Survey reports for February. Analysts believe that the number of job openings in the U.S. fell below 10 million in February, indicating that the labor market, which was once hot and supported the economy, has begun to slow. At Yardeni, president of Yardeni Research, said the number of job openings relative to the number of unemployment remains large, but the market is still very sensitive to any small change in the direction they don't want to see. After the release of job report, U.S. Treasury yields fell across the board on Tuesday. The size of job openings in the U.S. fell to its lowest level since May 2021 in February, indicating a significant cooling in the job market. Analysts said this means that the Fed may end its interest rate hike cycle earlier and start a new easing cycle earlier. Such market bets are directly positive for the bond market, and the yield on the 2-year U.S. note, which is most sensitive to interest rate policy, fell by 14 basis points, which also reduced the yield spread between U.S. bonds and German bonds in the same period to the narrowest level since 2021. Because compared to the Fed, the market is generally believing that the ECB will continue the tightening process longer under the inflationary pressure of Qualcomm, and it is still possible to rule out the possibility of a 50 basis point rate hike by the ECB at the May policy meeting. Energy market have emerged as another potential source of uncertainty after the Organization of the Petroleum Exporting Countries and its allies unexpectedly announced 1.16 million barrels per day in oil cuts. US WTI crude futures posted their biggest one-day gain in nearly a year on Monday. Some analysts believe that this is the oil-producing countries exercising pricing power that is about to be lost. Quincy Crosby, chief global strategist at LPL Financial, said, given that the world is undergoing a transition to clean and green energy, OPEC Plus is very clear that liquid gold that they still highly cherish will start to lose its luster at some point. Until that moment comes, OPEC Plus dominating countries will be more direct and active in their use of crude oil prices management as they prepare trillions of dollars rebuilding infrastructure and focus on major revenue streams beyond oil, she said. Analysts said the prospect of higher oil prices could stoke inflation and recession fears. But Mona Mohanty, the senior investment strategist at Edward Jones Institution, said she doesn't expect the market to price in a second recession after a pretty severe bear market in 2022. She said that if there's some volatility in the market, it is more likely to be a normal correction of 5 to 15%, which will set the stage for the market to rise in the second half of the year. Reducing U.S. stocks are heading for a consolidation period, maybe some volatility, she said. She highlighted corporate earnings, market expectations, and for Fed policy, and a downturn and slowdown in lending during the banking crisis as three headwinds that are growing in influence. And JP Morgan Chase strategist Marco Kolanovic said that the risk sentiment that drove the stock market up this year will reverse. Adverse factors such as banking turmoil, impact of OPEC Plus production cuts on the oil markets, and slowing economic growth will push stock back to its lows of 2022. Chris Harvey, the head of equity strategy at Wells Fargo, said the upcoming earnings season could be the first of several difficult quarters ahead of the possibility of a recession looks more certain. Harvey said the Fed and the U.S. Treasury helped cushion some of the effects of the turmoil in the banking sector, but access to capital will become more difficult in the second half of the year, which will have an impact on the economy. In general, Harvey said, the period leading up to a recession can be challenging, with neither the Fed nor the economy being able to bail out underperforming companies. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.